Welcome back, listeners, and thanks for listening this morning. My name is Larry Kallevig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you are listening to the Haven Financial Group radio show, where weekly we discuss crucial retirement and financial topics that really can make the difference between just surviving retirement and thriving through those golden years, which we truly hope are golden. I want to bring the listeners' attention to havenfinancialgroup.com. We have all kinds of classes. We continue to teach these classes throughout the course of the year. We got a great speaker coming up at the AIM Center about health and wealth management classes, havenfinancialgroup.com. We encourage folks. Education is really where it starts, so we can make good decisions, good retirement decisions, because ask yourself, do you remember all those classes growing up that taught you how to make all the perfect retirement decisions? And I bet you're listening and going, yeah, I don't remember all those classes. Well, come to one of ours. You might learn something.
I love that. I am sure I don't remember any of those classes, so I feel confident many of our listeners feel the same way. We're talking about taxes today because, of course, we are in the middle of tax season. And while it may not be a subject that everybody loves, it's one that's so very important. And missteps certainly can result in you paying your favorite uncle more money than maybe you'd like to. So Lance Larsen is with us, CPA there at Haven Financial Group, a man who knows everything there is to know about taxes. We wanted to take a minute here to discuss the taxation of 401ks and IRAs. Obviously, Lance, this is the most common source of retirement income for many of our listeners. So it's imperative that they understand the way these are taxed. So let's get started with 401ks if we could.
Yeah, Kim. So 401k plans are employer-sponsored retirement plans. Typically, they're going to be funded with pre-tax dollars, which means that you get a deduction for that the year that you make the contribution. Then that contribution is going to grow tax-deferred, meaning that it's going to be taxed once you take that money out. So if you had somebody who's been contributing to a traditional 401k for their entire working career, you could have 30, almost 40 years worth of contributions and growth. That income is going to be taxed once you get to retirement. And depending on how much you take out, we're going to be subject to the different tax brackets. So this is something that we want to think about and plan, because I've seen people say, oh, I just need to have $250,000 a year. Well, they take all of it out of the pre-tax accounts, and then they don't realize that, oh, they have given almost 35% of it to the government between Fed and state. Mm-hmm. They also don't think about the other ramifications with Social Security that, hey, now you've taken too much. You've now hit an IRMA bracket, and now you're paying more for your Medicare. So it's not just the taxes themselves that we need to be worried about. It's going to be a lot of other factors going on.
Yeah, absolutely. This is all part of, by the way, this strategy planning that Larry was talking about in our first segment. You know, it's one thing to drop your taxes off and just get them done. It's another to make a plan so that some of these penalties that were just mentioned by Lance don't befall you as you draw your money. Let's talk about, so that people understand, I think most people do, but Roth accounts. Now, both IRAs and 401ks offer Roth options, right?
For the most part, yes. The IRAs definitely do, and most employer plans at the 401ks are now starting to offer Roth accounts as well. So before we were talking about the traditional ones where we get the tax deduction today in order for it to grow tax deferred to be taxed later on. The Roth accounts, whether it's in the 401k or the Roth IRA, you are contributing after tax money, and therefore it's going to grow tax-free to not be taxed when you take it out in retirement.
Okay. All right. And these decisions, moving these around and maybe moving money from your 401k into a Roth, whatever the case may be, these are decisions that you really need to make pretty far in advance, right?
Yes, but also at no at the same time.
Okay.
So if you have somebody who's just starting out, Sure, Larry and I sat down with children of our typical client age, and we've talked with them. And generally speaking, we want the younger generation to contribute to a Roth because their income is a little bit lower. It makes more sense to get hit with the taxes today versus getting hit with the taxes later on.
Mm-hmm.
Then we can have some more of our pre-retirees that are still working. Well, for them, they're making some decent money. It actually would be better to pay the taxes later because they're in a higher tax bracket today. So while, yes, it kind of makes sense if you know exactly what your future is going to be, the earlier you can make the decision, the better off you are. But let's face it, nobody has a crystal ball. Nobody knows what's going to happen. So we can just have our general guidelines that we can follow.
So let's talk a little bit here, Lance, about required minimum distributions. These can really have a tax implication. Number one, you don't want to miss the dates because then you're going to pay penalties. And number two, you really need to plan for these, don't you?
You do. So with the required minimum distributions, depending upon your age, before RMD started at age 70 and a half, then it was raised to 72. Right now, most people are going to be who are turning 73. This is when the RMD is going to kick in for them. In a few years, we're going to have those who were born in 1960 or later. Their RMD age is actually going to be age 75. So RMDs are going to be triggered on your pre-tax accounts. So in the beginning, when we talked about your traditional 401ks, where we take the deduction today and then it grows tax deferred, RMDs are because Uncle Sam has been patient enough and they want their tax revenue. So they're going to force you to take at least a certain percentage out. These percentages are based upon life tables that actuarial studies have done. Right now, at age 73, the percentage works out to be about 3.78%. And then it will go up from there. So that's where it is going to be very much of a calculated number. We can plan for those. And then we want to plan around that so that we can keep ourselves in a tax-friendly bracket as much as possible. The one thing we'll also note that RMDs stand for required minimum distribution. So if you calculate it out on that 3.78% on $100,000, we're looking at $3,000 or almost $3,700, excuse me. More than likely, you're going to need more than just $3,700 throughout the year for retirement. Well, that's great. If you take out enough to live on, as long as you are taking out more than the minimum, then you have satisfied it. You don't have to look at trying to take out a more just because of the RMD.
Okay, very good. Again, these are dates, and we heard Lance say these dates change depending on when you're born, and these are going to change in the future and be pushed back to some. But they're important dates not to miss, not just for tax ramifications, but also, obviously, there are penalties associated with not drawing that money out. All reasons to have a partner to strategize with and to try to put together a plan that makes sense for you and protects your money. Larry, let me ask you, do you anticipate changes in the future when it comes to tax laws could have a big implication when it comes to 401ks, IRAs, or whether you need to be in Roths? What do you see for the future?
Well, change is inevitable. And here's what I'll say. How many of you know, the listeners, how many of you know the tax code doesn't always make sense? I think I know the answer, and I can't even hear you say it, but it doesn't always make sense. And guess what? When you figure it out, guess what they do? They make more changes. Just like Social Security doesn't always make sense. And guess what? Then they make more changes. So change is inevitable. And if you're listening going, oh my goodness, this is just so much to understand, the timelines, the implications, the tax implications, what I'll say is if you have a good partner that you're working with, you don't have to do it alone. You don't have to know all this stuff on your own. You can have somebody that you work with, that you trust, of course, that puts the time in, the energy to help you understand things, explain things. make you aware of when these changes actually happen. What does it mean to you? With all these changes and then retirement hits and all those years you put in a 401k and it was kind of out of sight, out of mind. And now you have to put this retirement investments to work for income purposes. It's more important than ever to understand how this affects you. So that's why we're here. We're here to help. Have a partner, figure it out. Give us a call at 612-504-8400. Find somebody, especially if you're not getting the attention right now. Retirement, we're just touching a little bit on taxes today and Social Security, but there's all the retirement puzzle pieces. It's much more than a meeting once or twice a year for 45 minutes to an hour. That's just not enough time spent. I don't care if you have a lot or a little, complex or simple. This should be something that requires discussion and really a really good partner that you can rely on and trust in.
612-504-8400. Give the team at Haven Financial Group a call. When we come back, we're going to talk about generational tax planning. This is the Haven Financial Group radio show.